You bought a pair of shoes on Afterpay last month. Maybe a couch on Klarna. No big deal, right? 4 easy payments, no interest. But here's the question nobody's asking. What did that do to your credit score? And if you're thinking about buying a home this year, could those little payments actually cost you the mortgage? I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Let's talk about buy now, pay later. You've seen it everywhere. Afterpay, Klarna, Affirm, Zip. You're checking out online, and there it is. Pay in 4 no-interest payments. Sounds like free money, right? And honestly, for a lot of people, it works fine. You split up a purchase, you pay it off in 6 weeks, you move on with your life. But here's where it gets interesting and where a lot of folks are getting caught off guard. FICO just rolled out brand new scoring models late last year. They're called FICO Score 10 BNPL and FICO Score 10T BNPL. For the first time in history, buy now, pay later accounts are being factored into your credit score. That's a big shift. Now, before you panic, let me give you some context. For most consumers, the score impact is going to be around 10 points in either direction. That's smaller to what happens when you open a new credit card. Not the end of the world. If you've been making your payments on time, you might actually see a small bump. FICO's own research showed that consumers with 5 or more BNPL loans from a provider like Affirm would most likely see their scores go up, not down. So responsible use can actually help you. But here's the catch, and this is the part that matters. If you're thinking about a mortgage, not every buy now, pay later company reports the same way. Affirm reports everything to all 3 bureaus, Experian, TransUnion, and Equifax. Every payment, every missed payment. Klarna, they report their longer-term loans to TransUnion, but their popular pay-in-4 plans, those don't show up at all. And Afterpay, they don't report to any of the 3 major bureaus. So you've got this patchwork situation where some of your BNPL activity is visible to lenders and some of it isn't. Now you might be thinking, well, if it doesn't show up on my credit report, that's a good thing, right? Not necessarily, and here's why. Mortgage underwriters in 2026 are doing what I'd call forensic level reviews of your bank statements. They can see those automatic payments going out every 2 weeks. They can see you've got 3 different BNPL plans running at the same time. And even though those payments might not appear on your credit report, they absolutely count toward your debt to income ratio. Let me give you a real world example. I had a client come in, great credit score, good income. On paper, their debt to income ratio looked like 35%. That's solid. But when we pulled their bank statements, we found 4 active buy now, pay later plans. Furniture, electronics, some clothing. When we added those payments in, their DTI jumped to 47%. That's above the threshold for many loan programs. And it's above the threshold for many real strong rates. We had to have a very different conversation than what they were expecting. And that's what the CFPB calls shadow debt. Their January 2025 report found that 63% of BNPL borrowers had loans from multiple providers at the same time. A third of them were using 3 or more different services. That's a lot of monthly obligations flying under the radar. Here's another number that should get your attention. 61% of BNPL borrowers in the U.S. fall into subprime or deep subprime credit categories, and 41% of users reported missing at least 1 payment last year. So we're not just talking about a convenient way to split up a shoe purchase. For a lot of families, this is becoming a real debt management issue. So what should you do? First, go check your credit. Actually pull your reports and see what's showing up. Some of your BNPL accounts might be there, some might not. You need to know what lenders are seeing. You can get your free report at annualcreditreport.com. Second, check your FICO score. Go to rsrlinks.com/FICO, rsrlinks.com/FICO. That's our resource to see where your score actually stands today. Yes, it does cost a little money, not a lot. If you're thinking about buying a home in the next 6 to 12 months, this is step 1. You need to know your number before you can build a strategy around it. And third, if you've got multiple buy now, pay later plans running, start thinking about your total monthly obligations, not just what shows up on a credit report, but everything coming out of your checking account. Because when you sit down with a lender, that's exactly what they're going to look at. Here's what I want you to do right now. Go to rsrlinks.com/FICO and check your score. Then visit rsrlinks.com/keysteps for a step-by-step guide to getting your financial picture organized before you talk to a lender. Both links are free, both take about 2 minutes, and both could save you very uncomfortable surprises down the road. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Your Credit Matters segment, brought to you by rsrlinks.com/debt-free, rsrlinks.com/debt-free.